People don't lose money when markets fall. They lose money when they panic. In 2020, when the market crashed, millions of Americans sold their investments at the worst possible time. Not because they were stupid, because fear feels logical when prices are falling. But here's the truth. A 20% market drop doesn't destroy wealth. Bad decisions during that drop do. Today, I'll tell you exactly what I do when markets fall 20%. No hype, no predictions. Just rules that keep me calm when everyone else is stressed. Let's start with reality. A 20% drop feels like a disaster when you see your portfolio every day. If you had $100,000 invested, suddenly it looks like you lost $20,000. That hurts. But in the US market, this has happened many times. And every time, people believed this time is different. In March 2020, during COVID, the S&P 500 fell more than 30% in weeks. People sold because they thought the economy was finished. But within months, markets started recovering, and many who sold never got back in. The market recovered. Their confidence didn't. That's the real loss. When markets fall, news becomes emotional. Every headline sounds urgent. Worst crash since. Recession fears rising. Investors panic. News is designed to get attention, not to protect your money. So the first thing I do is simple. I stop consuming daily market news because information during panic rarely helps decision-making. It increases anxiety. Instead of asking, what will happen tomorrow, I ask, has the long-term reason I invested changed? Most of the time, the answer is no. This is where most people make mistakes. They look at portfolio value instead of financial stability. If your income is stable, your emergency fund is intact, and you don't need the money soon. A falling market is uncomfortable, not dangerous. In the US, many investors panic because they invest money they might need in 6 or 12 months. That's not investing. That's pressure. Before markets fall, I make sure bills are covered, emergency savings exist, no forced selling is required because forced sellers always lose. This is where ego destroys returns. People say, I'll sell now and buy lower. Sounds smart, almost logical, but nobody consistently predicts bottoms. Even professional fund managers fail at this. In 2020, many investors waited for another drop after selling. The market went up instead. They waited and missed the recovery. So I don't try to be perfect. I try to be consistent. If I was investing monthly before the drop, I continue investing during the drop. Same plan, same discipline. When prices fall, people forget what stocks represent. They see numbers falling on a screen, but stocks are businesses. Companies still sell products, people still use services, the economy keeps moving. If strong businesses become cheaper, long-term investors are not losing opportunity, they're gaining it. The problem is psychological. Discounts feel good in stores. Discounts feel scary in markets. Same concept, different emotion. Imagine someone invested $500 every month into index funds from 2015 to 2023. They experienced the 2018 drop, the 2020 crash, the 2022 decline. If they stopped investing during crashes, their returns would be significantly lower. But if they continued investing through fear, they bought more shares at lower prices. Time rewarded patience, not intelligence, not timing, just consistency. When markets fall 20%, I remind myself of one thing. The market is the only place where people run away from discounts. I don't celebrate crashes, but I don't fear them either, because volatility is the price of long-term growth. If you want stable returns every day, markets are the wrong place. If you want long-term wealth, temporary drops are part of the journey. I don't try to win every year. I try to win every year. I try to survive every bad year, because investors who survive downturns are the ones who benefit from recoveries. Survive first, profits come later.